Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first Fed's 25 basis point rate cut sparks a 500-point Dow rally, but a divided vote signals a high bar for future easing. So we'll discuss why this divided decision creates future volatility and what it means for the battle between market expectations and Fed policy. Second UK economy unexpectedly shrinks 0.1% in October as the services sector stalls, fueling speculation of an imminent Bank of England rate cut. We'll analyse why this contraction strengthens the case for a policy divergence and how it could trigger a significant drop in the British pound. Third, a UK net zero delay promises £500 household savings, but a new report warns this path invites EU carbon tariffs and higher long-term costs. Today, we'll take a closer look at this short-term savings versus long-term cost trade-off and its implications for UK industrial competitiveness and trade policy. The Federal Reserve just delivered a rate cut, but it came with a massive warning shot. The Fed cut rates by 25 basis points, but its own projections show only one more cut for the entire next year. A while back, we talked about how the Fed's $40 billion T-bill purchases looked like stealth QE paper hawkishness paired with easier plumbing. Today's twist is that the dots now codify a high bar for easing, even as liquidity support still cushions the system. The Fed is now caught in a tough spot. The situation presents a fascinating duality. On one side, a commitment to appear tough on inflation, while on the other, a job market that's starting to show cracks. You know, for the past 2 years, they've focused almost entirely on their mandate for stable prices. Now that's changing as they pivot back to their other mandate, maximum employment. Here's where it gets interesting. There's a key indicator called the SARM rule, which signals a recession when the 3-month average unemployment rate rises 0.5 percentage point from its low. We're not there yet, but the latest data shows we are moving in that direction faster than expected. This could force the Fed to cut rates more aggressively than their current plan suggests. Federal Reserve Chair Jerome Powell called the decision a close call, and the vote was the most divided it's been since 2019. Believe it or not, a divided vote isn't just a piece of trivia, it's a powerful signal of future volatility. When the committee that sets interest rates can't agree, its forward guidance becomes less reliable. This fracturing of consensus historically leads to more uncertainty and increases the risk of a policy error. Wall Street initially celebrated sending the Dow up nearly 500 points, but the move signals a potential battle between the central bank and market expectations. So the market is cheering for the immediate rate cut, but the real story is the underlying tension. The key to watch is the upcoming employment data. If unemployment continues to tick up, the Fed's hand may be forced. But that's not the whole picture. The real turning point in today's market action was actually in the tech world. Oracle, a supposed AI winner, saw its stock plunge 11% after missing revenue targets. This happened even as the company reported its remaining performance obligations. Its signed backlog soared over 400%, a jaw-dropping number that makes the revenue miss even more jarring. This highlights a growing gap in the AI world between promises and profits. The problem is, it takes a very long time to build these massive data centers and recognize that contract value as actual revenue. This creates a bookings versus billings gap that is now testing investor patience. The fallout dragged down other AI stocks. Meanwhile, in a stunning reversal, Cisco hit a new all-time closing high, its first since the dot-com bubble peak in 2000. This contrast shows a market getting smarter about AI, differentiating between giant unrealized contracts and established revenue-generating businesses. And the conflicts aren't just in the markets. Geopolitics just took a dramatic turn. President Donald Trump announced the US seized a massive oil tanker off the coast of Venezuela, calling it the largest one ever seized. This action represents a major shift in strategy from purely financial sanctions to direct physical interdiction. It's a big deal because it could reintroduce a tangible geopolitical risk premium into oil prices, which could scare shippers away from servicing sanctioned countries, disrupting crude oil flows and complicating the global fight against inflation. This volatility is forcing major corporate shakeups. Struggling EV maker Rivian is pivoting to host an autonomy and AI day, while at Coca-Cola, Henrique Braun will take over as CEO to face cooling consumer demand. So the thing is, the era of incredible pricing power for major brands may be ending, we are now seeing signs that consumers are finally hitting their limit. After all, competitors like PepsiCo have already seen sales volumes drop after their own price hikes. This signals that the last mile in the fight against inflation could be the hardest, and it may lead to shrinking profit margins for these normally safe stocks. Speaking of economic pressures, the situation in the UK is looking even more precarious. Just as economists were predicting growth, the UK economy slammed into reverse, shrinking by 0.1% in October. Now, this measurement, the gross domestic product or GDP, is the main report card for a country's economic health. A contraction, especially when it was unexpected, is a clear sign the economic engine is sputtering in real time. And this isn't a minor blip. It's the second straight month of decline, raising major red flags. A massive cyber attack on Jaguar Land Rover choked car production, contributing to a staggering 17.7% collapse in vehicle manufacturing over the last 3 months. However, if you zoom out, you'll see this cyber attack merely exposed a much deeper vulnerability. The UK's auto industry is actually caught in a perfect storm, simultaneously battling post-Brexit trade frictions and intense competition from Chinese EV manufacturers. The weak rebound points less to a one-off shock and more to a deeper structural weakness in the UK's industrial base. The weakness is spreading far beyond the factory floor. The UK's massive services sector, which makes up 3/4 of the entire economy, recorded zero growth. That zero growth figure isn't just a number. It reflects a worrying trend in consumer behaviour. Even with real wages rising, the fear of a recession is leading people to save instead of spend. This is a big problem, because if consumers don't spend, the services sector can't grow, risking a much deeper recession. One deputy chief UK economist at Capital Economics noted, "It's striking that the economy has only grown in one of the past 7 months." A former Bank of England advisor was even more blunt, telling the BBC the economy is, quote, "unambiguously weak." What really brought this to a head was a single critical event, the Bank of England's meeting next week. The unexpected contraction has dramatically strengthened the case for a major policy shift. If the Bank of England starts cutting interest rates before the US Federal Reserve or the European Central Bank, it creates something called a policy divergence. For investors, this is a huge signal. A move like that could trigger a significant drop in the value of the British pound as global capital seeks higher returns elsewhere. With the economy now actively contracting, the pressure is immense. From one tough policy choice in the UK to another, headlines are screaming that a slower path to net zero could save UK households £500 a year. But a new report from Britain's National Energy System Operator, or NESO, reveals a far more complex and high-stakes economic battle. The most ambitious green scenario projects that costs will surge, peaking at a staggering £460 billion by 2029 before they start to decline. This huge upfront investment creates a classic economic trade-off. This decision brings both the short-term pain of what economists call greenflation, but also comes with the inherent benefit of avoiding a much worse long-term problem, fossilflation, which is the endless price volatility driven by unpredictable global fossil fuel markets. That £500 savings figure comes from a falling behind scenario, which models a future of slow climate action. When we place this falling behind scenario alongside the EU's new rules, the contradiction becomes clear. Major trading partners, especially the European Union, are rolling out a carbon border adjustment mechanism, or CBAM. Think of it as a carbon tariff. If the UK's carbon price is lower than the EU's, British exporters of goods like steel and aluminium will have to pay the difference. This could make UK exports less competitive and effectively means the UK would be paying the EU's carbon price anyway, with the money going to Brussels instead of the UK Treasury. The UK government is firing back, with a spokesperson stating, "We fundamentally reject the idea that these illustrative scenarios accurately reflect the cost of moving to clean energy." The real bombshell, though, is buried inside the official report itself. NESO issues a direct warning, quoting, "It would be wrong to interpret a delay in this cost as implying that the cost is avoided entirely. And the logic is simple. That savings calculation completely ignores the price of pollution and the mounting cost of climate damage. When you factor in those carbon costs, the story flips. The greenest scenario actually becomes the cheapest over the next 25 years, saving an estimated £36 billion a year compared to taking slow action. According to climate experts citing global data, Damage from the climate crisis has already cost a whopping £13 million an hour, every hour, for the past 2 decades. The core conflict isn't about a £500 household saving. It's about a multi-billion-pound upfront investment versus the astronomical and ongoing cost of inaction. The Nesso report makes one thing clear. Delaying the spending doesn't eliminate the bill. It just changes who pays and how much more they will owe later.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.